It's finally here, the week of the US presidential election. Hello everyone and welcome back to Morning Markets here at True Potential. Finally, in only a few days, we should have a clear idea of who will be the new President of the United States of America. Markets have taken the uncertainty relatively well over the last month or so. And that's because both candidates are only a different shade of the same theme. Neither candidate is promising to reduce the US deficit, and that should help support US growth no matter what the outcome. US GDP continues to grow above trend, and the recent data points that is all being driven by consumption from both government and private businesses and households. It's an exceptional backdrop for the US economy, and in the short run, neither candidate's policies will likely change the outlook. However, we know that both candidates have a very different agenda, and that's what markets will focus on following the result. The bond market in particular has been hedging its bets over the last couple of weeks with higher bond yields, and that's really reflecting the shift in polling and the probabilities towards Donald Trump. Markets expect even more spending from Donald Trump, extending tax cuts, perhaps putting in place new business tax cuts, and obviously some of his more broader themes such as tariffs on imports, particularly from China. Markets are slightly concerned about the inflationary impulse from this, and so bonds have taken the whack and have risen in yields over the last 4 or 5 weeks. In fact, bonds have done a remarkable round trip since April, where they haven't really risen over the last 7 months. We saw a marked fall over the summer as markets reacted to some slightly softer data from the US jobs economy. However, all of that is unwound following much stronger jobs data through Q3, but also some sticky inflation data and also some sticky wage data. However, inflation does appear benign around about 3%, and that allowed the Federal Reserve to cut interest rates last month, and they will likely cut interest rates again. But of course, one market which is inextricably linked to the next President of the United States is the UK, and that's because of our budget. So on Thursday, the Bank of England will update markets on their outlook for monetary policy. We expect a 25 basis point cut. However, they may have to readjust their outlook based on some of the more acute inflation pressures perhaps within Chancellor Reeves' budget. That is, the increased spending we know is going into higher wages for those on the minimum wage and also into public services. And the OBR predict that will raise inflation by about 0.5% over the next year or so. That's likely to filter in to the Bank of England's adjustments as well. So we should expect a more nuanced communication from the bank, even as they cut interest rates. They may likely increase their horizon for uncertainty, pointing to the likelihood of inflation remaining above target once the current energy price effects drop out. So it's going to be a tremendous week for politics. We will have the new president by the middle of the week, and then the Bank of England becomes the first official institution to react to that with their new forecasts and their statement. So please do join us over the week as we will update you on a variety of media. We will have a podcast dedicated to the election special on Thursday. We'll also have our weekend markets coming towards the end of the week, as well as our morning markets. We will keep you up to date with all of these events. So please stay tuned. It's going to be a remarkable week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.